For the past week, crypto headlines focused on a single point. The first U.S. spot XRP ETF has gone live. But if you look closely, many of those headlines didn't explain how the product functions, how it acquires XRP, or why certain on-chain movements appeared around launch. Today, we're stepping back from the news cycle to look at what public filings, historical ETF behavior, and early analytics suggest about this moment. The picture that emerges is measured, structural, and far more long-term than any headline alone conveys. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. We begin with what's confirmed. A new physically backed XRP product, marketed under the ticker XRPC, has been launched by Canary Capital. Physically backed means the trust must hold actual XRP corresponding to issued shares, with custodial responsibilities assigned to regulated entities named in public filings, including Gemini Trust Company and BitGo Trust Company. This model aligns with traditional commodity-style structures, where the underlying asset must be directly held rather than synthesized. It's also worth noting that XRP has had exchange-traded products, or ETPs, in several non-US markets for years. These operate much like ETFs by holding actual XRP on behalf of investors. But XRPC is the first physically backed product available in the United States, and those global ETPs already account for a meaningful amount of XRP that sits in long-term structures instead of short-term trading activity. What receives far less discussion is how ETF markets typically evolve after a first approval. Historically, once a new asset class receives its first spot ETF, whether Bitcoin, Ethereum, or gold, additional issuers often follow. Analyst trackers currently list several firms with pending spot XRP ETF applications, including Grayscale Investments, Bitwise Asset Management, 21 Shares, CoinShares, and WisdomTree. Their applications remain under review, and approval is not guaranteed. But the presence of multiple filings suggests broader institutional interest in XRP exposure through regulated wrappers, following patterns seen in other maturing asset categories. Over the coming weeks, a few signals may help indicate whether the ETF ecosystem begins expanding. Brokerage platforms often add new products gradually as they complete internal reviews. New filings, if submitted, would show which issuers see potential demand. And historically, once competition increases, asset managers often begin investor education campaigns and fee adjustments. None of this predicts an outcome. It simply reflects how ETF markets tend to develop as additional assets enter regulated channels. To understand how money flows into a physically backed ETF like XRPC, it helps to examine the role of the authorized participant, or AP. APs are specialized firms responsible for creating and redeeming ETF shares. When investors buy shares in the open market, APs may subsequently need to deliver XRP to the trust. The method they choose for sourcing that XRP depends on liquidity, spreads, inventory levels, and their own risk models. In many cases, APs source XRP from existing inventory accumulated over time. In other cases, they work through over-the-counter desks. OTC trading is common in digital asset markets because it allows institutions to move significant amounts of XRP without impacting retail exchange books. A desk can fill large orders privately, then hedge its exposure gradually across public venues. This makes institutional sourcing appear less dramatic than many retail observers expect. Direct exchange buying by APs tends to occur only if OTC liquidity tightens or spreads widen. Even then, execution is typically algorithmic to reduce slippage. This explains why ETF inflows and short-term price movements often diverge. The early Bitcoin ETF era in 2024 demonstrated this clearly. Broader access created steady structural demand, but the price response unfolded gradually, rather than through immediate spikes. Turning to XRP, several analytics providers noted significant outflows, roughly 149 million XRP, leaving exchanges within a 24-hour window around launch. These numbers vary between providers and should be interpreted cautiously. Exchange outflows can reflect custodial rebalancing, cold storage movement, OTC desk preparation, or standard operational transfers. A single day of activity is not enough to draw conclusions. Meaningful interpretation requires multi-week observation. Another detail worth noting is commentary from Farsight Investors, a group known for producing popular ETF flow dashboards for Bitcoin and Ethereum. They indicated they do not plan to maintain a similar daily flow monitor for XRP at this stage. This does not affect the ETF itself, but it does mean flow tracking will rely on issuer reports, visible on-chain wallet activity, and exchange balance data instead of a unified dashboard. Now, let's widen the frame. Evernorth, a company preparing to go public through a merger transaction, has stated in public materials that it expects to raise more than $1 billion in gross proceeds. Their model centers on building a large institutional XRP Treasury, with the future trading symbol expected to be XRPN. Analyst estimates and on-chain observations suggest Evernorth may have already accumulated several hundred million XRP. These figures are provisional and not yet audited, but they indicate meaningful movement around institutional-scale XRP holding strategies. A Treasury-focused model differs significantly from a passive ETF. While ETFs primarily serve as access tools for investors, a Treasury can support operational functions such as liquidity management, collateral support, and participation in tokenized settlement processes. The exact nature of Evernorth's operations will depend on regulatory conditions, institutional relationships, and how the merged entity progresses once public. Another topic that surfaced recently involved claims about tax-free XRP. Ripple's CTO clarified that the XRP ledger does not implement any form of built-in tax mechanism. The only protocol-level cost is a minimal anti-spam fee that is burned. This should not be confused with personal or corporate tax obligations, which vary by jurisdiction and remain entirely separate from blockchain protocol rules. Stepping back, several patterns emerge. If ETF participation expands, if additional issuers move forward, if OTC and AP activity stabilizes, and if large treasuries such as Evernorth's continue to develop, XRP exposure could gradually shift toward longer-term, regulated structures. This is not a prediction for price. It reflects how market structure tends to evolve as institutional channels mature around a digital asset. As always, this analysis is focused on infrastructure and access. I don't offer price predictions. Viewers can draw their own conclusions about how structural changes may influence markets over time. So here's the measured conclusion. The launch of XRPC occurred during a broader period of institutional focus on regulated custody, professional liquidity sourcing, and enterprise-grade blockchain adoption. ETFs, treasuries, brokerages, and stablecoin systems all serve different functions, yet each can reinforce the others as the ecosystem grows. If these trends continue, the overall market structure supporting XRP may deepen and stabilize. Ultimately, regulatory developments, institutional participation, and real-world demand will determine how that potential unfolds. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.